Today's episode is sponsored by Raisin UK, a free, easy-to-use platform that helps you make the most of your savings. What's more, for a limited time only, you can receive a £100 bonus when you register and fund your first savings account with a minimum of £10,000 using the code SAVINGS100. For more details, please visit the link below or go to raisin.co.uk/PensionCraft. The UK stock market is shrinking. Since 2007, the number of listed companies has fallen by 45%, and those that remain trade at stubbornly low valuations compared to global peers. As British firms flock to foreign exchanges, is the London market dying a slow death?
We ask what's driving the decline and can it be stopped? And in today's dumb question of the week, what is the new Pisces private stock market? All right, let's get into it. Now, Romin, I don't think we want to be accused of being a couple of gloomsters about the UK economy, but sometimes it's hard to see the upside here, and the stock market is one of those things that's been struggling. In fact, I asked you this morning, what's going well in Britain? And you said, well, I baked a pretty tasty sourdough loaf yesterday. One of the few things that's rising.
Yeah, it doesn't look great, does it? It is quite a depressing episode, so I'll warn viewers that that's going to be the case up front.
The facts are a little disturbing. So the UK stock market is shrinking at the fastest pace in a decade. And as of the end of last year, the number of listed companies in the UK had declined from around 3,250 in 2007 to fewer than 1,800 today. That's a pretty astonishing pace of delisting.
So perhaps it's good to think about the dynamics of a stock market and just to talk through how stocks are created and how they disappear. Now, obviously, the creation process is when a stock first lists, it goes to the exchange, it's doing well, perhaps, and it wants to raise more capital to grow. So it lists on a stock exchange, maybe the AIM exchange, because that's for small companies. And if that's successful and the market cap grows, it'll move into larger indices. So it might make it into the small cap index, and then it'll make it into the mid cap index, and then the large cap index. So that's the creation process. And then, of course, companies do disappear. And that might be because the company goes bankrupt, it might be taken over, or it might delist because it goes private.
Or it might move its listing overseas. And we have seen that in the UK, which we'll come on to later. But to go back to that creation process, when a company first becomes public, you'll often hear it referred to as an IPO, an initial public offering. And that is at a 30-year low on the London Stock Exchange. There's only been 5 new listings on UK markets in the first half of this year, raising just £160 million. And to give it some context, that's a 98% fall from the first 6 months of 2021, which was one of the best recent years on record. There's almost been nothing really, has there, this year?
Yeah, and there's no way to sugarcoat that. If you actually look at the graph, which was from the FT, it is nothing short of catastrophic. So if this is the way that things pan out in future, if there isn't a turnaround, then this is going to be a real problem for the UK market. Because if you stop the creation process, if new companies aren't joining the exchange, then at a certain point, the natural attrition rate for companies will whittle down the number of stocks, and that's exactly what we're seeing.
And it's important to remember the kind of life cycle which you hinted at. These new companies joining the index are the pipeline that eventually, hopefully, become the large caps, at least some of them. So if you've only got a trickle of new companies becoming listed small caps, eventually you're not going to have any listed large caps.
Yeah, so the whole process is effectively being cut off at the base.
And also some of the head is being chopped off. So we've seen some very high-profile companies opting to list outside the UK. So notably recently, Wise, which is a fintech company, moved its primary listing to the US. It had said back in April that it was exploring its options, but I think it came as a bit of a surprise to analysts that it went so nuclear, although it has maintained a secondary listing in London. And I think what's ominous is that its shares rallied more than 8% after it announced it was heading to New York.
Yeah, you can kind of see the arguments behind it. And if a company does list on a different exchange, the questions you have to ask are, why did they move? And was it a rational move? And in this case, I think it was. I think for fintechs, it makes a lot of sense because that's a market which really does dominate in that sector. So investors are much more willing to stump up capital if you need to raise more capital, and the valuations you get are going to be higher. So for the same profits, exactly the same profits, you could get more cash through the door for the same amount of dilution. So just to explain that, the dilution effect, if you issue more shares, it upsets your existing investors because when a dividend's paid out, it's paid out to more people. And of course, they're saying the company's diluted as well because your shareholder votes become less effective.
You become an increasingly small fish in a bigger and bigger pond.
Exactly. And that doesn't make investors happy. But if you did want to raise more capital, I think the US is a more friendly place to do that for a fintech.
I think some of these companies are also looking at the market and saying, well, our biggest customer base is actually in America. Why wouldn't we want to be listed there as well?
And here you probably should think about Brexit and what it's meant for companies. Previously, the UK was seen as a doorstep to Europe and an unfragmented market, which gives you access to Europe, which is fragmented. Now we're not seeing that because the UK's pretty much decided to go it alone. So one of the big reasons for listing in the UK has now gone away. And I think it's unlikely that foreign investors will just want access to the UK market. It simply isn't big enough.
I don't think you can underestimate the effect of Brexit. Yes, in terms of the economics and the projections that economic growth will be slower and all of that, but also just on sentiment. As a foreign investor, I reckon they looked at Britain and said, well, what's going on there then? It seems less weird now, given that populism and anti-globalization sentiment has risen across most of the world. But back then in 2016, I think it looked a bit weird. And you can see it starkly on the graph of valuation multiples. If you compare the S&P 500 to the FTSE 100, back in 2016, the valuation multiple was actually higher for the FTSE 100. Like UK companies were commanding a premium over the US. And then over the course of that year, it just dropped like a stone, reaching a multiple of almost 10 times forward earnings, which is exceptionally low, whereas the US shot up to, 30 times at the peak of its euphoria.
Yeah, I think that graph is pretty damning. It's very clear that the valuation break occurred with the Brexit vote, and it simply hasn't recovered.
Right now, UK stocks trade at a discount of around 42% to their US peers. So that's based on the forward price to earnings multiple. But you've got to remember the UK has a very different sector mix of stocks compared to the US. In the US, we know those big tech companies are quite dominant. The UK, we don't really have listed technology companies, not many of them. Our market's dominated by different industries like financials and energy companies and pharmaceuticals.
And miners.
And miners, all this stuff anyway. They're not so loved at the moment by investors. So once you account for the sector composition and re-weight the index almost, the discount to the US shrinks a bit to 25%, but that's still a big discount. And this is according to Goldman Sachs data.
And while that persists, then it is rational for companies to list in the US. So think of it from the CEO's perspective. If you're going to get a big payout on your shares, on your stock in the company, based on the valuation, well, of course, you choose to get 25% more money. So you can see why there's this kind of downward spiral effect on the UK market. You get this lower valuation, you get a less liquid market, and then it becomes a less attractive place to list your company.
And we have seen rumours that some of the really big beasts of the FTSE 100 are considering moving to the US. So last week you saw a lot of reporting around how AstraZeneca, which is a massive pharmaceutical company, is reportedly looking at shifting its stock market listing from the UK to the US. And this was an exclusive run by the Times. And I'm not sure if there's more reasons behind it other than what we've discussed. I think it was notable that earlier in the year, AstraZeneca had a bit of a dispute with the UK government where there was this proposed investment that was going to take place in Liverpool. They were going to build a big vaccine manufacturing facility. But in the end, they pulled out and said the government's not offering enough financial support here to make it viable. So whether that's having a knock-on effect and making them reconsider being based in the UK, I don't know. It is all sort of off-the-record reporting. The company hasn't said it's going to move. But it would be a big deal if they did.
But there is a good aspect to that news story, which is that the United States Secretary of Health and Human Services, Robert Kennedy, is reputed to be anti-vax. So perhaps you wouldn't want to list in a country where that's the case.
I don't see that having a massive bearing on their decision, do you?
Well, I have spoken to people who work in the pharmaceutical industry who were just having coaching sessions with me, and they were terrified about the new legislation which is coming out of the US. It certainly is very concerning for pharmaceutical companies to see this huge shift in attitude towards science.
Oh, yeah, a lot of federal funding is being pulled. Scientists, I think, are increasingly leaving the US. But remember, AstraZeneca or any other company could move its listing without necessarily moving all its staff or anything like that.
Yeah, they could still do research in the UK, in Europe, and not do it in the United States. But still, I think that is worrying, and it's something which is in our favour.
And they're far from the only UK listed company who's looking at moving abroad or who has confirmed that they're going to. So Ashtead Group, which is a 20-odd billion pound construction rental company, they revealed at the end of last year that they're going to move their primary listing to New York. We've also seen Flutter, which owns Paddy Power, decide to move to New York. And there are companies that are moving to places other than New York. So TUI, the holiday company, decided to go to Frankfurt. And Unilever decided to list the Ben & Jerry's subsidiary in Amsterdam rather than London. And most notably, I think, we mentioned the UK doesn't have much of a listed tech sector. It could have, conceivably it could have. We have Arm, which is a UK-based company, which decided not to have its primary listing in the UK. Revolut, the fintech, also opted for the US. And you've got to remember that if you go way back, we let Google buy DeepMind, which is now at the forefront of the AI revolution. So we have a tech sector, it's just not listed in the UK.
There's a great quote from the boss of Revolut, who's called Nick Storonsky. And he said, I just don't understand how the product, which is being provided by the UK, that's the listing, by the way, can compete with a product provided by the US. If I get better product from the UK, I'll list in the UK. But so far, if you just compare these products, one is far ahead than the other. And he's also complained about the stamp duty charge for trading UK stocks, which he said meant listing in London is not a rational choice compared to the US. So pretty scathing.
Yeah, a lot of executives make the point that the listing rules in the UK tend to be quite restrictive. They are restrictive in the US as well, maybe less so in some senses. But remember, the US offers greater liquidity, so they can kind of set the rules and people abide by them. We perhaps have to offer an incentive for companies to list here. And stamp duty is just so out of line with international peers. So it's a fee of 0.5% when you buy stocks listed in London. That's just a huge disincentive when there is no stamp duty on most exchanges in the world.
And there has been discussion of changing the rules. The FCA has been talking about this, but so far nothing concrete has happened.
I believe in the middle of last year, the FCA did announce an overhaul of the listing rules in London aimed at boosting growth and simplifying the process for companies. But as yet, it hasn't seemed to have had much of an impact. And I don't think it's the primary reason that the UK stock market is struggling. Maybe after the break, we'll come back and really dig into what we think the reasons are why we're falling behind other countries.
If you're looking to make your money work harder, check out Raisin UK, the simple no-fee savings platform. Access exclusive accounts from FSCS-protected banks and manage everything with one login. What's more, for a limited time only, you can receive a £100 bonus when you register and fund your first savings account with a minimum of £10,000 using the code SAVINGS100. For more details, please visit the link below or go to raisin.co.uk/PensionCraft.
Okay, so it's pretty clear that the UK market is not the most attractive to investors or companies right now. And if you think about the reasons why, the first one that springs to mind is obviously liquidity, which seems to be lower in London versus the US, for example.
Yeah, so we've talked about the primary market. That's when a company first lists its stocks. This is about the secondary market, when you've got existing stocks which are traded between investors. Now, if you're buying and selling stocks, what you care about most is the bid-offer spread, how much you pay to buy and how much to sell, and you want that to be as tight as possible. Now, for a less liquid market, the bid-offer spread is generally wider, and that means for fund managers, it's more expensive to trade the stocks. For asset managers, it means that if you've got an index which is based on UK stocks, then it's more expensive to maintain. And for just normal people like you and I, it just means that you're not getting such easy and fast access to the market. So liquidity and a lack of liquidity is really a big problem for a market. If it doesn't have liquidity, then that makes it very unattractive.
I think for institutional investors who are trading in massive size, what they care about is being able to buy or sell without moving the price too much, right? And if you've got a shallow market with not much liquidity, they just can't really do that. Like if they go and buy a load of stock, it's going to push up the price.
Yeah, for example, you've got measures of liquidity like the Anna Hood measure, which looks at how much a given trade will move the market. And if you don't have a very deep trading book, then that's the problem. It can move it a lot.
Interestingly, I saw that recently the FCA issued a discussion paper around liquidity on the UK stock market. And they said that all these reports around lower liquidity might be overstated when it comes to London, because a lot of the trading no longer happens like on the public market. It happens bilaterally, they said, which we're not really measuring properly.
Now, the whole point of an exchange is that everything happens on the table. You can see who the actors were, you can see the amounts traded, you can see the impact on the market. If people start doing these kind of under-the-table trades, then I think that's a worrying sign in itself.
There was some data that says that bilateral trading, like the off-exchange trading, has reached 40% in May of this year, which has grown from around 30% just a few years ago. But does the FCA have a point? Like, if this is getting on for half of the trading activity that's not being captured on the exchange, then maybe liquidity is twice what we think it is in the UK.
Well, if the trades aren't happening on the exchange, then the bid-offer spreads are going to be wider because the market makers have to pay their private school fees. So I don't agree that it's not a problem. I think it is a problem. It's not just an artifact of how you measure liquidity.
Well, apparently the FCA said if the change in market structure means that an increasing proportion of that liquidity is now executed bilaterally, such an approach could distort perceptions of the UK's market depth and attractiveness, both as a listing venue and for investment decisions. So they're hinting that it could be a big problem and one worth looking at. Now, I don't think just sort of fudging the numbers and multiplying up what the apparent liquidity is going to convince anyone. But it might be a problem if our bilateral trading is higher than other markets. Now, I don't know if that's the case.
Yeah, I remember a while back, dark pools were kind of attractive. And this is an example of bilateral trading where you don't know who the counterparty is. So this is a fairly commonplace practice for large institutional investors.
I guess what matters is the scale of it, right?
Exactly.
But if you're looking for a reason why the UK market has struggled for such a long time now, perhaps a lack of institutional demand is one of the core reasons. Now, a lot of people point to the fact that our pensions industry, which was a big buyer of UK stocks a couple of decades ago, has been slowly shrinking its holdings and buying gilts instead, effectively. And this is particularly the case for defined benefit pensions, which in general are no longer open to new members and are in runoff, basically. They're just paying people as they become pensioners. And all they care about is meeting their liabilities, like having enough money to pay the pensioners while they're alive. And so they don't care about growth so much. They're really liabilities matching. And what you care about there is certainty over cash flows. And so what do you buy? You buy gilts. In fact, this was driven by legislation. We wanted to de-risk defined benefit pensions. So we kind of forced them to sell their stocks, which in large part was British stocks because they were British pension funds. And their allocation to UK equities has gone from around 48% in the year 2000 to just 6% now.
And you know what they can do? They can actually buy anything they like and then use swaps to make sure that the duration of their portfolio matches their liabilities. But guess what was really knocked for six when we got the trust budget? Yes, it was LDI-driven investing. So that's no longer an option. And, you know, that's a real problem now, which is that they're forced by legislation to do the liability matching. So it's difficult to make the case for buying lots of equity in the UK.
But this has been a massive structural headwind, right, facing the UK stock market. That these big institutional buyers have become big institutional sellers for a long time now, a couple of decades.
And so that begs the question, who's going to buy the UK stocks? Are foreign investors going to flock onto our markets to buy our stuff? Well, probably not. What's the attraction?
Who's going to hold the bag?
So I can certainly see why the government is talking about encouraging pension funds to buy UK stocks and invest in UK infrastructure.
But they're talking about defined contribution schemes there, and specifically the default plans within those schemes. So people who are saving into a workplace pension now, for the most part, are in a defined contribution scheme. Their money's in their own pot. There's no sharing of risk with the company or with other investors. And most people, I think something like 90%, leave it in the default plan. So if the government could force those default plans or incentivize them, if you want to be nice about it, to buy up UK assets, then maybe they can turn the tide of flows. But I think there'll be pushback from the industry. I saw today an article in the FT where the boss of Lloyd's was saying, well, if you're strong-arming pension funds into buying UK assets, that's quite a lot like capital controls. Did you see that, Roman?
No, I didn't see that, but it is. It is. I agree with that. So look, this is all very negative, Michael. So let's make some positive points about the UK market.
Well, I didn't sign up for this. Go on then, carry on.
There we are. Look, I'll be positive and you'll shoot me down, okay? So firstly, if you like income, you can't beat the UK. It's got a brilliant dividend yield. These companies pay out a very high dividend compared to the US, which gives you almost nothing. So for a certain group of investors, I think that's very attractive. And a lot of retired people like that a lot. Number two, the valuation's unbelievably cheap compared to the United States. Not just a little bit cheap, but almost at an all-time record difference in valuation. It doesn't depend on which valuation measure you look at. Almost anything will tell you that that's the case.
The only thing that says that might not be the case is if you look at something which takes account of sales or profit growth. Something like PEG, I think we don't look so great because our profits and our revenues are not growing.
And that brings me to another point, which is the planned military spending. Now, if the promised boost does happen, which I think it probably will, then that's going to benefit many companies. And of course, this could lead to greater spending in the UK by the government, which flows into the economy generally.
Okay, so we've got cheap valuations, we've got high dividends, we've got a government that might spend a lot of money, especially when it comes to military rearmament. Any other reasons you think you might want to buy UK stocks?
Yes, I'd say that the innovation you get in the UK, we really do punch above our weight there. So if you look at UK universities, if you look at the number of scientific papers which we publish and the ideas we come up with, we really are very innovative as a country. And I don't think that's going away. So it's more a matter of harnessing that creativity, both in science, in the arts, for the film industry, and monetizing it better. I think that's really what it's about. And if you look back in time, there were periods when we were incredibly innovative because we had these concentrations of brain power. So there was a great story in the FT by Gillian Tett recently where she was talking about the Lunar Society. And this was like an 18th century version of Silicon Valley. So there was a network of entrepreneurs, scientists and citizens. And it was based in Birmingham, of all places, which is close to where I was born in Worcester. And it was called the Lunar Society because that's when it was easy to travel, because the moon would kind of light the way. But this led to a huge melting pot of ideas, which led to things like the discovery of oxygen, carbonated water, advanced steam engines, and ceramics. And guess how it ended? Yes, with populism and people turning against this scientific innovation.
So your argument for why the UK stock market's best days are ahead of it is this 18th century Lunar Society. Is that right?
What I'm saying is that we're very innovative and that hasn't gone away. It's more a matter of concentrating the ideas in one place, which then leads to these innovative technological changes.
We could really do with some bright, fast-growing unicorn startups that decide to list in the UK and don't get bought out by big US tech companies. Like we need someone to do a kind of proof of concept where they go all the way through the journey and end up in the FTSE 100 as a massive company, right? It's been a while since we had that.
But who knows what it's going to be? It could be biotech, and that's a field where we do really well and where we do have an environment which is friendly to scientists, which the US perhaps no longer is. So a lot of these disruptions which we're seeing in the United States and the change in tone you get politically in the United States could be very favourable, as scientists might choose to move here and do their research here.
I agree with that. Like, we've got to capitalize on this moment where the US is shooting itself in the foot when it comes to science and technology. And we have Oxford and Cambridge and that.
And Imperial. Don't forget Imperial.
Oh, sure. We have this huge university sector which punches above its weight. Like, surely we can harness that.
And it's not just that. When it comes to monetary policy, you don't get our Prime Minister giving his opinion about how the monetary policy decisions should go. So having an independent central bank, also a big plus in my opinion.
Liz Truss has had a lot to say about how the central bank screwed her over. I don't know if you've been following that.
Yes, I have. And it would be a risk, I think, if we did get a populist government in the UK, which currently it looks like we're going to, that we're going to get our own mini MAGA set of policies. Whereas at the moment, I think a big benefit of the UK is that we don't have that mindset.
I mean, we'll see what happens. We're still a long way away from the next election. I think just to go back to the point around where are the buyers for UK stocks, right? If pension funds have stepped back, I think it's fair to say that in the UK, we have a much weaker retail investing culture, certainly than in the US, if you just look at the number of people who own stocks, for example. So it would seem unlikely that it's going to be the man on the street who steps in to buy British equity. Is it going to be overseas investors? Well, as we said, maybe Brexit put them off. You are seeing quite a lot of private equity activity over the last couple of years, buying up listed British companies and taking them private. But if you look at just the willingness to invest in UK public markets, Bank of America has a regular survey of fund managers. And the latest one from June showed that global investors are a net 4% underweight the UK. And it's been around that level for the last few months. So it doesn't seem that there's a rush into our markets from abroad. And I wonder if macro is a bit of a headwind here. We're an economy where we have significantly higher interest rates than the Eurozone, more like America, right, than the Eurozone, which obviously means a higher cost of capital for our companies. And this is presumably because inflation looks like it might be a bit stickier here versus a lot of other countries. We've also seen the pound getting stronger versus the dollar. Like, the dollar's had an atrocious first half of the year. And as a lot of our listed companies, certainly the big ones in the FTSE 100, earn a lot of their money abroad in dollars, if the pound's getting stronger versus the dollar, that's not good for their earnings.
Another problem for manufacturing, I think, is the cost of energy. Our cost of energy is so high compared to the rest of the world, and that makes it very difficult to compete on the global stage. So sorting out energy independence, which is a step that we are now taking, which is great, that's going to be really key, I think, for manufacturing. But really, it's services where we dominate and where we're really good. So encouraging that rather than trying to slow it down, I think that wouldn't be a bad idea, particularly for financial services. And education, of course, is a big export for the UK. So clamping down on immigration, where a lot of that immigration is due to students who are coming from abroad, well, that's not a negative, that's a positive, because firstly, they experience UK culture and become more UK friendly. And secondly, it's a big generator of revenue.
And if you can get the brightest of those students to stick around a while after they graduate and form companies here or join early stage companies, then who knows what can happen? Maybe we will get some unicorns.
And again, policies in the US are really helping us here, because if they're going to clamp down on foreign students, as we've seen for Harvard, then this becomes a much friendlier environment in comparison.
One of the challenges, I think, is for UK companies to go beyond that nascent startup stage, where there is a lot of capital available for early stage companies, seed funding in the UK. But once you grow it to a certain size, is taking that big leap where you can compete with the American hyperscalers. That's something we've not been good at, I think.
Yeah, I think that's true. And people often go abroad for capital when that happens. I've spoken to CEOs of companies in power hours and coaching sessions where they were telling me that's exactly the case. They just couldn't get the money in the UK.
It's hard to compete with that VC culture on the west coast of America.
So along with the Lunar Society, you need some financial firepower to back it up, a set of people who are willing to fund companies, even though they understand that it might fail.
Yeah, you need the Lunatic Society. Those VCs willing to throw money at, a pitch deck.
Well, look, if you believe in unicorns, you have to be a lunatic.
But certainly so far, the companies that have grown and are massive in the UK, as we said, they're being tempted by maybe going to America for their primary listing. And as we said, primarily that's for reasons of valuation. They think they can just be a more valuable company without changing anything about it other than where the stock is listed. But there is a question here of, do these companies that abandon the UK and list in New York, do they actually benefit from a higher valuation? There was a piece in the FT earlier this year said, US listings often fail to boost European companies' valuations.
But this sounds a little bit like a couple splitting up, where one person says, look, you'll be sorry you left me. Do you think that's the case?
Well, maybe, but I'm trusting the FT to go through the data without a kind of bias, but I don't know. Let's read a bit of it. It says, an analysis of 12 European listed companies that have added US listings since 2016. So this includes Ferguson, CRH and Flutter. The analysis found that in half of those cases, valuations fell, while in a number of cases there was no uptick in the number of analysts following the stock. However, 2/3 of the companies did enjoy greater liquidity in their shares.
So look, you can take a company, you can move its listing to another country, but fundamentally the business is still the same. They do what they do and they've got to grow those profits. So if you can make capital available more readily, then maybe that will boost future growth. But really, it's the fundamentals of the company that matter. The people who work for it, the sector in which it operates, how innovative it is, and whether it's got good management.
The FT article seemed to make out that relatively smaller companies that decided to take a US listing benefited much more than large companies moving, which I guess makes sense because the liquidity for large companies was already probably pretty good in London.
Yeah, that's when you need the capital, isn't it, when you're growing?
Anyway, I thought it was interesting that this move, which on paper looks like a no-brainer, right? If you're just completely agnostic about where you should be based, then you think, well, why would I go to London? I may as well go to New York. But then the stats don't show that it makes a huge difference.
Yeah, you'll be sorry.
We'll see if any come back. I doubt it. Now, just to wrap up here, we've been kind of negative on the UK market, and it's clear that it has shrunk a lot over the years. If you go back a century, I think it was the biggest market in the world, wasn't it?
Yep. The UK was the biggest and the US was a backwater.
So I kind of wonder if it's not so much a problem with the UK market, it's more just reflecting what's happened to the UK economy. Are we not just shrinking our market back down to size at like 3% of global market cap rather than it dying?
I think that's partially true. But there's another thing to consider, which is if you look at a map of markets globally, most of the global map won't be shaded at all. So amongst the countries which have a developed and deep stock market, I think probably by right, we should be more than 4%.
Yeah, maybe. I think people just look at America doing so well and say, well, why can't we have a bit of that stardust here? But then if you compare us to other European markets, I don't think we're much of an outlier.
Yeah, so maybe there isn't a problem. Maybe we should just get used to having 4% market share globally.
Yeah, you don't want it to shrink to 3, then to 2, then to 1, and then eventually all companies are listed in New York.
And look, a key point here is a real problem would be if we were growing more slowly than other countries. And I don't think that's the case. We have been lagging the US, but so is much of the rest of the world over the last decade or so. So you can still make money by investing in the UK market, probably as much as you could make in other markets. But of course, you have the added benefit that you're helping companies in the UK. And that's certainly part of the reason why I have this UK small cap portfolio. I just do think that it's helpful to the UK economy in a small way, if all of us do that.
I'm only willing to help if the returns are there, I'm afraid.
So you're part of the problem, Michael.
Yeah.
So should you invest in the UK? Should you invest elsewhere? These are the kind of questions which is useful to discuss with other people, and you can do that as part of our community. To learn more about joining us, just go to our website, pensioncraft.com/membership.
Okay, today's dumb question of the week. What is the new Pisces private stock market? So this was something that the FCA had been consulting on and then formally announced just a couple of weeks ago. And it said a new type of private stock market will be launched later in 2025 after the FCA announced the final rules for its private intermittent securities and capital exchange system, which luckily abbreviates to Pisces. I suspect we're going to start hearing a little bit more about this as the year rolls on.
But this is a great choice of name, I think, because there are lots of puns on the word fishy.
Yeah. Smells a bit odd, doesn't it, Robin?
To me, it does. And I think I'm always wary of the private anything because of the transparency.
This is kind of a weird hybrid between private investments, where usually you would have some sort of investment bank going and talking to high net worth individuals and being like, we've got this company, they're unlisted, they're growing, do you want to buy some shares? Not a very efficient process, lots of fees, not much transparency. I think the idea with this private stock market is to be some sort of hybrid between that fully private model and then the public stock markets, where you've got all the regulations about the financial information the company has to provide and its auditing and things around insider trading. Like, there's a lot of rules that they have to abide by. And then you have this liquid market where everyone can just trade as they please. So how are they going to square that circle, Roman?
Well, I think it's interesting looking at the requirements here. There are certain requirements on reporting, but it's nothing like being listed on a stock exchange where you have to report on a regular schedule. Now, one of those requirements, which I think is important for a publicly listed company, is that if you do have market-moving information, it has to be made available to the entire market simultaneously. Otherwise, you can get insider dealing. Now, apparently that's not a requirement, or at least not as stringent a requirement for this market.
That's certainly what it appears to be. FT Alphaville's done a really good piece called Anything Goes on Pisces, London's bottom-feeding private stock market. And they say the requirement is just to give core information only before trading opens. And there seems to be no requirement on companies to tell investors about litigation they're facing or guide on any forward-looking information or forecasts. I think they're exempt from sustainability standards.
And weirdly, they do have to say if they've been audited, but there's no requirement to be audited.
Yeah, I like that.
Now, you could argue that the auditing is a waste of time anyway, but still, I'd rather know than not know.
I don't know if it's a waste of time. Like, auditors do find things, and we often see companies having to restate their accounts when the auditors just won't sign off on them. And I think just the process of knowing you're going to be audited enforces a kind of discipline on a company. And a lot of cost, it has to be said. But I think in general, this idea of a private stock market is going to be appealing to people who already own the private stock. I think this Pisces market will not allow companies to generate new capital. It's just for secondary listings, so it's for insiders to sell their shares. And interestingly, there seems to be no requirement for major shareholders to announce what they've sold, though I think companies will retain the right to approve or deny certain purchases of their shares, so they can't be bought out by a competitor secretly, for example.
But look, I think there is a big plus here, which is that one of the problems with private equity is working out what it's worth. If you never see the trades, and if the trades are very infrequent, then who knows what the true value of the company is? At least with this, we'll have a chance of seeing what the true value is based on market expectations.
I don't know if you'll be able to access the market though, Roman. It says access to Pisces will be limited to institutional investors, high net worth individuals, sophisticated investors, and employees of participating companies. Maybe you're the sophisticated investor if you bother to do the box ticking exercise to get that accreditation.
Well, it wouldn't be so much for the actual trading itself. I think if they publish the prices, that could be useful. It could be interesting. And we could even have some kind of private equity index, which itself would be tradable. So there may be other things which come out of this, which could be positive.
Yeah, I just wonder if it's the UK from a regulatory point of view. Again, being a bit distracted from reforming its public markets. We see it from the government again and again, especially when it comes to this pensions discussion. They're so obsessed about getting pensions money pushed into private markets, into infrastructure. I kind of think, well, the big problem here is our public market is failing. And I hope that this Pisces market works, but I also hope that it doesn't incentivize companies not to go and list on the public market, which is what we ultimately want, so we can all buy into the company. But then there's a lot of cost in listing on a public market. As we said, this private market is exempt from a lot of these regulations. So if it's working well enough for companies, maybe they won't want to list on the public market. And something you'll both love and hate, this Pisces exchange appears to be exempt from stamp duty.
No.
Yeah.
Oh, dear.
But what do you reckon, Roman? Are you going to go fishing on the new Pisces exchange?
No, I think I'll continue to cast my net in deeper waters of listed markets.
I mean, there's still plenty more fish in the sea. For now, in the UK market. Not for long, but for now. Thank you for joining us for many happy returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out PensionCraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Roman Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.